Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Tom Mackenzie. Anna is off today. Kriti is in Berlin. We'll be with her shortly. Cash trade, an hour away. So what do you need to know this morning? Let me tell you. The ECB is expected to cut rates today for the first time since 2019. We're going to take you live to Frankfurt for that event. Chip stocks are leading equities to fresh record highs. ASML is now bigger than LVMH. Nvidia is now bigger than Apple. Plus, 80 years ago today, Allied troops had just hit the beaches of Normandy. President Biden will be touching down shortly to join Allied and European leaders in northern France to mark the moment. We're going to bring you those live pictures from Normandy. Tom.
Let's check in on these markets then. Yes, fresh records once again for the S&P, the 25th time so far in 2024. And European markets looking to take the hand off from that optimism then. Nvidia driven, of course, largely in terms of the gains of yesterday. European futures pointing higher by 0.4% as we look to that expected cut from the ECB. FTSE 100 futures on a rally in commodities looking to add 0.2%. The US 10-year back below that 430 level. Yields up just 1 basis point, but they dropped 4 yesterday. 428 on the benchmark. Euro dollar, of course, in focus ahead of the ECB decision, gaining 0.1% on the single currency. Markets today starts right now.
Good morning. It is Thursday, the 6th of June. The 6th of June, 80 years ago today, the amphibious invasion of Europe was firmly underway. We're going to take you live to Normandy throughout this show and focus on what is happening there as global leaders, as corporate leaders gather to mark that event. Our main focus, though, this morning is a different event in Europe. It is the ECB's gathering in Frankfurt. We are going to be firmly focused on that event throughout this show. The first rate cut since 2019 when it comes to the deposit rate from the ECB. So let's walk you through the choreography of what today looks like. 1:15 p.m. This is UK time, the ECB rate decision. We then get initial jobless claims. Keep an eye on that out of the United States. The trade balance data is there as well. The D-Day 80th anniversary events, 25 world leaders expected in Normandy. The EU Parliament elections. Also, we're going to see voting starting, and it is the last day of SuperReturn. Kriti Gupta's got some fantastic guests lined up throughout the morning, many of them in this show, and we will be focusing firmly on what those guests have to say as well. But the main event in Europe today is that, from a financial markets point of view, is that ECB meeting. Tom, the first cut since 2019. I am fascinated. I want to see the staff projections, and I want to see that press conference, because in some ways, the rate cut is the non-event today. Yeah. It's kind of what comes next. That's the exciting bit. That's what I want to see here. Is the ECB in danger of making a mistake here? It pushes too far down the dovish line. Because they've been flagging this June cut since what? The early part of this year. This is an ECB that says it's data dependent. Christine Lagarde has said that. And yet, from the beginning of this year, flagging June. To your point, are you lining up potentially for a policy mistake, given that some of the data has suggested inflation is a little sticky? We have a great chart that shows the 4-month lag that seems to be there in terms of how the inflation story has evolved in the US versus in Europe. So we look at that. The forecast, the core inflation story as well. They have a forecast of 2% by 2026. The Bloomberg economists' analysis is if they adjust that higher, maybe that suggests in terms of the sequencing you get fewer cuts. And there's that divergence already between the economists and the markets in terms of how many cuts are expected this year. Let's go live to Frankfurt. Lizzie Burden is standing by. She's going to be covering this event throughout the day. Lizzie, we've kind of laid out some of the big picture stories that we're going to be covering. Walk us through what you're expecting to come out of not only the results, but the staff projections and also that press conference.
Yeah, Guy, we've just seen Robert Holtzmann, the Austrian representative, going into the central bank. Christine Lagarde, not long before him. She did not want to cut rates before the Federal Reserve, but it looks like she's going to today. This quarter-point cut to 3.75%, well telegraphed, fully priced by markets, almost unanimously expected by economists. But as you say, the economic data recently has muddied the picture. Inflation sticky, wage growth rapid, and there's caution from especially the officials representing Northern Europe on the Governing Council. Council. So the focus on the path ahead beyond June will get those forecasts. Does inflation get upwardly revised for 2026? That would suggest a higher bar for cuts ahead. We also, of course, listen to the press conference. Does Lagarde suggest that we're going to get quarterly cuts? Does she suggest that after today there'll be a pause and a return to data dependence? It seems like we're going to have really strong signalling of cuts ahead for there to be sustainable weakness in euro-dollar.
And you talked about and you nodded to the fact that the Fed is, to some extent, the elephant in the room in this story. The first time that the ECB would be cutting ahead of the Federal Reserve. Talk to us about how the inflation story has evolved and whether or not there is synchronisation in terms of the stickiness of prices that we're seeing between the US and Europe.
Well, of course, the start of the inflation story, Tom, was very different on the two sides of the Atlantic. For the US, it was all about that massive fiscal stimulus. But here in the euro area, it was more about the energy crisis after Russia's invasion of Ukraine. But at this point, parallels are being drawn again between the two because of how difficult it's becoming to tame inflation. And the question being asked is, if they ease now, does it become a policy error later? So we've had some reservations expressed by the likes of Joachim Nagel and Isabel Schnabel about a July cut. Holtzman saying that he only thinks 2 cuts are going to be needed in 2024. And if you look at the pricing, yes, economists see 3 cuts this year, but traders are only pricing 2 cuts fully for the rest of the year. So when I was last stood here, Tom, in April, we were talking about this divergence between the ECB and the Fed. Perhaps we may not see as much of that throughout the rest of 2024. Less euro-dollar weakness, less of a boost to equities.
Lizzie Burden in Frankfurt, thank you very much indeed. Lizzie's going to be joining us throughout the morning as we march towards that event, that rate cut we are anticipating from the ECB and that press conference. Keep an eye on the star projections as well. They're going to be fascinating. We'll talk more about this throughout the programme. Let's talk, Tom, now about what's happening with these markets. In some ways, that rate cut is part of the premise to why European stocks have done so well recently. But the real driver, certainly, and we saw that evidence yesterday globally, has been this chip story. Just the numbers yesterday, Nvidia powering higher, ASML on an absolute tear, now bigger than LVMH. Yeah, the superlatives are there, and they are numerous. And part of it is the rate story. Yields lower. That, of course, is a boost for tech. But it's much more about the fundamentals as well, particularly for a company like Nvidia. You had the lines, the story, the confirmation that TSMC, of course, the owner of the most important foundries globally, is taking and will be taking ownership of one of ASML's lithography machines at the end of this year. You cannot make the most sophisticated chips without those. That came through. ASML, as you say, a lift of 8% in terms of the stock price yesterday. The second most valuable company now in Europe, above LVMH. Some would say that's a welcome change, given that they actually make something useful. And then Nvidia. The Nvidia story. Are you suggesting that LVMH doesn't make things that are useful?
God forbid. Nvidia, again yesterday. It looked almost... It seemed inevitable that Nvidia would take over Apple in terms of market cap, above $3 trillion.
I think Cathy Wood's appearing at the top of the next hour at the Greenwich Forum in Hong Kong. The question I guess you have to ask her is, do you regret...
She sold last year, I think, Nvidia, the stake. She was relatively early in, but then sold and has missed out on 200% plus or something.
Morgan Stanley out with a positive note on ASML as well yesterday. Really quite a strong note in terms of sort of pushing that stock higher. So the analysts continue to ratchet up the expectations around this space. You just you do wonder, given what's happening in the bond market, given the the signals the bond market is maybe seeing from the global economy and the concern it has maybe about what is happening with a slowdown, how tenuous maybe some of these sort of super stock moves that we're seeing maybe are. The compare and contrast, I think, is interesting.
As in, just the spending around capex on this AI move, does it collide with a slowing growth environment?
Yeah, can capital markets, can equity markets continue to charge higher at the rate that they have been? I think it's the 25th. Was that the 25th? Record high we saw yesterday. The numbers, as you say, the superlatives are easy to spot, but the compare and contrast with the bond market sniffing something happening, maybe a little bit different to maybe what the equity market. The equity market tends to be late to that narrative. Always wants to see the glass as being half full. You're suggesting the bond market is potentially sniffing the outlines of a recession in the US. The jobs data, the ADP. You were flagging this earlier in this week in terms of the importance of looking at ADP. And that came in softer as well. So just building out that picture of a labour market in the US that is cooling. But services, that data came in through strong. Absolutely, it did. The one thing that I will take away from the last few days, though, is that the market is absolutely shocking at predicting political outcomes.
This is something you've harped on about, and rightly so.
India
Harped on is a bit of an unfair adjective. But you're absolutely right. India, South Africa, really fascinating. And let's not forget Mexico as well.
Yep, and we've got European elections coming up.
Let's cross over now to Ollie Crook, who's been doing a fantastic job of making the European elections jump out for us, enlivening it. The Netherlands, the first country to kick off 4 days of voting in the European parliamentary elections later today. More than 370 million people across 27 EU nations are eligible to take part. Ollie Crook with the details. Ollie, talk us through the timeline for voting among EU nations. The Netherlands, the Dutch, kicking things off.
Yeah, the first votes in the EU election have been cast actually just 40 minutes ago in the Netherlands, and really sort of beginning this process. That'll elect the sort of 31 MEPs that they get out of 720 that will be elected over the next 4 days. As you say, 350 or 370 million people voting. We get Ireland tomorrow, but you really get the big votes starting on sort of Saturday with Italy, and then Sunday when you get most of everything with France, Spain, Germany, all of these sorts of people. And by Monday, you have an idea of what parties have actually been elected to the European Parliament. What begins then is where the intrigue starts, is where will these parties actually sit within the European Parliament, within these sort of broader groups. And from that, you get to have an idea of kind of which groups will begin to be able to work with one another. Then it gets kicked to the leaders for more sort of cloak and dagger, backroom discussions, who they want to put up to be the president of the Commission. Right now, the front runner is Ursula von der Leyen. And then it goes into another sort of bit of intrigue for us, which is the secret ballot of MEPs. And that is this sort of new crop of MEPs that will be voting on the president. And you need a majority there. You need 361 votes. Ursula von der Leyen only won by 9 votes last time, so this is going to be very, very sort of interesting over the next coming weeks. If everything goes to plan, there are no snags, no bumps, nothing like that, we'll have an idea of what the architecture of this government of the EU looks like for the next 5 years at around mid-July.
Ollie, there is an expectation that we are going to be seeing a significantly strong showing from the right of the political spectrum. And I'm wondering how long it is going to take for that impact to manifest itself. How long before what we see at the elections, at the ballot box, you just laid out some of the choreography, starts to impact policy? And also kind of give me an idea of also what's going on in Germany.
Yeah, well, listen, I mean, we can try to tie all of these together, Guy, because it's actually sort of really relevant. And the sort of EU elections are very interesting beasts, right? Because it's a canvas on which you have a lot of different kinds of political expression. On the one hand, you have sort of people who are actually voting for EU policy and the ones who are taking it very seriously. And, this party does this that I like. But it's also a referendum on national polls, right? So in Germany, you're going to have a referendum on the government, which is not the most sort of intensely popular right now. And as you've mentioned, Guy, there's been this big surge on the far right. But that has really, at least in Germany, got a lot of the wind come out of the sail over the last couple of weeks. There have been a number of scandals within the AfD. So we need to question the sort of original premise. We will see how well actually the far right does. In terms of how that then translates into policy, I think this is where it gets really interesting. And it'll be dependent on what groups they begin to sort of sit with one another. Like what happens with Marine Le Pen's party, what happens with the AfD, where are they going to sit, and then where are they going to be able to sort of work with others. The question is, Guy, where are you going to actually have issues that there is consensus? And for me, what is really interesting to look at is the issue of defense, right? There has got to be a sort of defense spending going on in Europe. We know this is going to be a fundamental premise, and it's something that the right is on board with, as well as the left. The question is, will you actually have consensus on the Ukraine side of that? Yes, military build out in Europe, but will you have the support for Ukraine?
OK, Oliver Crook, thank you very much indeed with the latest in terms of those EU parliamentary elections, with the Netherlands kicking things off. Coming up, the US has reportedly given the green light to antitrust investigations into Nvidia, Microsoft and OpenAI, all, of course, major players in the AI space. We're going to get the details on those probes. Plus, we are back at SuperReturn International. It is the world's largest private equity event. Let's find out what to expect today, then, from Bloomberg's Kriti Gupta, who is there for us. Kriti.
Yeah, Tom, Guy, it is all about interest rates, of course, for the ECB. In just less than a week's time, it's all about the Fed. That has a real effect on what's going on in these private markets and how deals are actually getting financed. We have a great lineup in the next 2 hours ahead, and we're going to be hitting those exact topics.
And if you have any questions of your own for our guests, send them to us on IB plus BBTV Go. We'll get them to Kriti as well. This is Bloomberg.
there are people that depended on a low-rate environment to get exits. And I don't think that low-rate environment's coming back anytime soon. I think rates will probably come down from here, but we are in this environment for some time. I think that's a good thing. Some of the businesses that relied too much on unprofitable growth are going to have challenges getting exits, frankly, at any price, at any time.
The valuation environment has fundamentally changed, and as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done, and all that means, it's just math, that returns are going to be lower over the next few years.
Investors look at their DPI multiples, how much money has been distributed. So I think there is a backlog of transactions that were supposed to happen in the last 12 to 18 months that have been delayed, but they are coming, and we're seeing that in the pipeline today.
We're seeing deal activity come back, certainly over a lower base from last year. And our view is that that's going to pick up over the course of this year into next year, simply because limited partners in private equity want to see their capital back.
In general, just the need for this type of capital is insatiable.
Some of the fantastic guests we've been talking to at the SuperReturn conference, which has been taking place, is still ongoing in Berlin. I'm back from Berlin. Kriti's not. The reason she's not is she's still got some fantastic guests lined up at this conference. Of course, this is the world's biggest private equity event, and it's still very much underway in Berlin. Kriti Gupta, let me hand things back over to you.
Yeah, Guy Johnson saw me in Berlin and ran in the other direction. So far, he went right back to the studios in London. Lucky for me, he might be able to make it up with a great guest. Chris Gordon, co-head of global private equity over at Bain Capital, joins me right here on a really crucial day for the interest rate environment. The ECB, of course, coming out with their decision, expected to be consensus of a cut. In less than 7 days, we're back at the Federal Reserve. This is an interest rate environment that is proving very challenging to navigate, regardless of whether you're in private equity or an investor in the public markets or an economist or even Jay Powell himself. Talk to us about what that means for tensions, perhaps, between private credit and private equity. What does that look like?
Yeah, thanks, Kriti, and very happy to be here. I think the dynamic we're going through right now as an industry is, we lived in an environment for, more than a decade with falling cost of capital, and both investors and financing sources and operating businesses got used to the idea that capital didn't really cost anything. And we're now a year and a half or 2 years into an environment where it actually does. And that's had to cause a lot of pretty interesting shifts in the market as we transition from, it was really the final chapter of that low interest rate environment was a very frothy, high valuation, high volume transaction environment. Of course, which was very much disrupted by rising cost of capital back in early to mid 2022, which has led to a lot of adjustments in the market. I think to your question, the first phase of that was, really banks backing off, being more, I would say, more judicious with their balance sheets in a way that took committed credit financing out of the market, which made it hard to transact. Private lenders, certainly to some extent stepped into that breach and were available, but quite expensive. And I think that caused a lot of challenges with buyers and sellers meeting in the transaction market. I think we are moving through that transition. Private credit markets continue to function, but the bank lenders are coming back as well. And I think we're all getting accustomed to the idea that you can still transact and do business in a higher cost of capital environment, but at different prices and in different levels and in different ways than we all got used to for almost a decade.
Well, how long is that mismatch going to take to sort out? I mean, when are we going to see perhaps a little bit more activity in the capital markets? When are we going to see actual buyout exits and this return? It feels like this industry is really feeling pressure on.
So we're starting to see more of it. What I would say is, if you rewind a year and a half or so and you're a seller thinking about selling an asset, it was pretty easy to say, look, the credit markets basically aren't functioning now, so this can't possibly be the right time for me to optimally sell my asset. I think your equation has changed a little bit now, because while cost of capital is higher, credit markets are actually functioning. Debt is available. You can transact. And so your question shifts from, well, if credit markets are basically non-functional, how can I transact, to, okay, interest rates are higher. I think most people believe, and I would agree with this, that while they may come down somewhat, they're going to be higher for longer. And so that's just the new reality. So your new question as a seller is, do I really believe interest rates are going to come down dramatically anytime soon, such that I want to wait for that? Or is this just the new reality and the cost of capital is what it is and I can transact?
So who snaps first, the buyers or the sellers?
it's always a process of each of them gradually moving towards each other. Sellers appreciating new reality, but also working with their companies to improve and operate better and earn into a higher valuation. And I think buyers fear uncertainty. And so the more we have periods of stability, which you could debate whether we're actually in a period of stability or not, but it certainly feels more predictable than where we were a couple of years ago, that can make buyers more aggressive as well.
But does that, as we have that discussion, as we have that rollout, the conversation I'm hearing this morning is healthy deal flow, healthy pipeline, optimism this morning, but then I'm also hearing valuations coming down, normalizing is a word that I believe you used as well. How much further do they have to, quote unquote, normalize? If valuations are coming down, how much further do they come down?
I think it's a very sector-by-sector discussion because the implications of higher cost of capital and how that flows through to...
So walk me through the sectors.
Well, so if I think about a sector like technology, technology is a sector that has a lot of correlation with public market valuations. There's certainly a number of public technology companies that are valued on long-term prospects of growing into meaningful cash flows. And so something like a higher cost of capital has real implications for public market valuations, and you've seen that reflected more rapidly in public market valuations than in some cases one did in private market valuations. So that's an example of a sector where this adjustment to a new cost of capital environment has more significant implications.
So very quickly, what does that lag look like? If you see some sort of, private markets have historically always lagged the public markets. There's been a delay in terms of the ripple effects. If you see some sort of correction or sell-off in the public markets, recession talks, Fed cutting rates, whatever that may be, whatever that catalyst may be, how long for it to show up in the private markets?
Well, I think one of the benefits of being a private owner is you can be patient. We're not forced to either buy or sell at any given point in time. And so you can focus a little bit less on what the volatility and day-to-day activity is in the public markets and think more about, what are the longer-term value creation approaches I'm taking with the companies that I'm working with. And so I think it can vary in terms of not necessarily what the absolute valuation is, but just the timing of when those sellers choose to transact.
All right, Chris Gordon, we have to leave it there. Co-head of Global Private Equity over at Bain. The program guy, Tom, back to you.
Okay, Bloomberg's Kriti Gupta at SuperReturn in Berlin. Thank you very much indeed, Kriti. And we're going to get more, of course, from Kriti Gupta in the next hour. She's going to be speaking to the head of private debt at Tikehau Capital. That's at 8:15 a.m. London time. And, of course, we're going to continue to get all the latest in terms of the ECB. A big, big day for, of course, the Central Bank of Europe expected to cut rates. But it's the forecasts around inflation. And, of course, it's the press conference, Guy, from Christine Lagarde that is going to be scrutinised as we look at the next steps beyond this decision.
Yeah, and what does that look like in terms of the frame of reference around the Fed as well? If you were the ECB right now, how much do you really want to give away? If you're Christine Lagarde, today's the day maybe to have a poker face. And is that what the market is anticipating? And if she plays her cards too close to her chest, then it is kind of cautious. We don't know what's going to happen. We don't know what's going to happen. We're going to wait and see what happens. Is that perceived as being hawkish?
So a hawkish cut, potentially, from Christine Lagarde, which would assuage, of course, the hawks on the Governing Council who have said, look, there's no need to flag July as the next step. Of course, that debate remains live. A question as well is if you get a dovish cut coming from the ECB, to what extent is that a further catalyst for these equity markets? You
look at pricing, options pricing in FX. There's the potential today for some quite big swings. So it is really this is a massive event for Europe today. I'm really looking forward to seeing what that press conference delivers.
And we're going to be speaking to senior economist at Pictet Asset Management, Sabrina Khanish, in the next couple of minutes on her view in terms of the path ahead beyond June. That conversation is next. This is Bloomberg.
Putting that ballast and putting that barbell around your portfolio is a really sensible thing to do, unless on Thursday the ECB comes out and says we have a lot more rate cuts to come. At that point, I would lean in much more to the cyclicals, the beta names, because I think if that is what you see, that is going to be a real rocket launch for the economy, particularly the small caps. If that's what the ECB do come and say on Thursday, Tom, I would be really leaning into those kind of names.
Are we going to see those kinds of cuts signalled from the ECB? That, of course, was Helen Jewell, the CIO for Fundamental Equities, EMEA at BlackRock, talking to Tom, yesterday earlier on this week, maybe, about what we should expect maybe from the ECB. I think they're all in the building. I think the process is underway. We are building up, obviously, to that key decision a little bit later on. We've got some great coverage lined up as we work our way to this really important moment for the Eurozone. Sabrina Kanish is Senior European Economist over at Pictet Asset Management. Good morning. I'm very excited. This feels like a kind of pivotal moment. The reason I'm excited is that, yes, we've had this rate cut today flagged. Nobody doesn't expect that we're going to see a rate cut today, but we don't know what comes next. And it seems really difficult to predict what the ECB is going to say today. So what are you anticipating?
It's especially because if we look at the recent data, they all surprised on the upside. They came on the hawkish side. So, but at the same time, if we make the comparison between the previous press conference, we had kind of a commitment for a rate cut because at that time it was going in the right direction for the ECB. If the ECB is confident enough that inflation is moving towards the 2% target based on the reaction function, in that case, it is a signal that they can ease the monetary policy restriction. And this is where we are now. I think that despite the fact that we had some pretty hawkish data, we know that it was not going to be a linear path. But despite that, the June rate cut is a done deal, but still we expect further rate cut after June.
The market's got priced currently, I think, another 1.5 rate cuts. So 20, let's call it 35 basis points. I can't remember what the exact number is, but in terms of what's priced between now and the end of the year. If the next cut comes towards the end of the year, though, is this a rate-cutting cycle that we're seeing here, or is this a kind of trying to finesse to put some nuance into this process? And how easy is that going to be to do?
The decision is always going to be meeting by meeting and data dependent. So if indeed there is confidence that, and obviously the forecast today will be key, because now we are focusing on the fact that inflation has surprised on the upside, wages actually were higher than expected at the end of the year, growth also has surprised on the upside. But is the ECB is confident that in 2025 the medium-term outlook, inflation is indeed going back to target? In that case, it's the start of the cutting cycle. But from here, and the communication today will be key, and the forecast will be key, obviously, just to see if indeed this is the start of a cutting cycle.
You say that this is always going to be data dependent, but it was at the World Economic Forum, Davos, in February, I think, when Christine Lagarde said June is likely to be the summer. June is likely to be the first time when they cut. So how data dependent is this ECB really?
It is data dependent. I mean, if the decision is taken based on the reaction function. So you have the transmission of the monetary policy, we have the underlying price pressure, we have the medium-term inflation outlook, and now they also consider inflation expectation. So if all those indicators are going in the right direction, which is the case, inflation expectation remain in court, underlying price pressure are losing momentum. I mean, if you look at the path, it is going on the trajectory is going on the right direction, and the outlook will be provided today with the projection. So in that case, this is going to give more evidence that the ECB decides to cut further going forward. So
a cut today is not a policy mistake in your view?
No, it's not.
This is really interesting.
And what are the potential risks then to the inflation trajectory for the ECB?
There are some upside risks. And obviously, the question is the ECB is going to look through those temporary factors? We know that the reasons or the factors behind the increase of inflation, notably linked to services pricing, so there are some temporary factors, but we cannot ignore the fact that underlying price pressure remains pretty solid, and this is because of the strong labour market. I mean, we had the unemployment rate, it has declined to a new low of 6.4%, so therefore the disinflation path is taking more time than expected because of sticky wages and because of sticky prices. But it is happening, and even if we look at the communication recently made by even some hawk governors, the wage negotiation or the wage prices, there is a wage moderation and little evidence of wage price spiral for the time being.
Okay, it's a hypothetical, but has the ECB made a mistake though committing to today? If it hadn't have committed earlier on this year, because we've been hearing this kind of steady drum roll, we're going to get some rate cuts, they're going to come in June, the ECB's kind of on track for that. The market locked this in a while ago, but subsequently the data has improved. Did it make a mistake going so early in terms of that commitment? Would it have been better if we hadn't had that commitment? Would they be going not in June but maybe in July?
Yeah, that's a very good point, and indeed, this is what the markets think. If we look at the now the expectations for the rate cut, it has been revised up. It has been revised significantly since the end of last year, since also the March meeting, because we had those data that came on the hawkish side. But at the same time, again, if we look at the ECB reaction function, we know that growth remains pretty weak. And again, we are not speaking about easing monetary policy. It's just an easing of the restriction. So. Economy was flirting with recession since the end of 2022. We had a recession at the second part of last year. Data has surprised on the upside, but the main drivers should be private consumption. But for the time being, it's not really the case. If we look at retail sales, they remain pretty weak. So there is an ongoing recovery. But here, it's about an easing of the monetary policy restriction. And even we have 3 rate cuts expected until the end of this year. Policy rate will remain restrictive.
What does that? Okay, so policy rates remain restrictive even with those 3 rate cuts. But if you those 3 rate cuts onto your outlook for growth then, and you talked about the fact that things are turning around now in the Eurozone, how does that affect the shape of the growth story for Europe? How sustainable is that growth story in an environment where you get, as is your call, 3 cuts this year?
Yeah, but this is, obviously, this is going to be supportive for sentiment. If we know that the monetary policy transmission has been pretty effective, if you look at credit growth and notably credit to corporates, it's pretty low. So this is going to provide some positive sentiment. We could see a positive impact on investment going forward. This is not going to happen this year because for the time being, as we discussed, financing conditions remain pretty much restrictive. But this is something that could happen next year. The same is true for net trade. So this is going to be to accompany, if I can say, growth. But obviously, the fact that growth surprise on the upside is another upside risk.
How much of a boost to European growth, and a lot of people are pricing this into equities right now, would 25 today, another 25, maybe another 25 after that this year? How long before you see the long and variable lags delivering an impact into the economy? How quickly will the European economy respond to those cuts?
That's a very good point, but I think this is not going to happen very rapidly. Again, because the monetary policy is going to remain restrictive. So, and we can see that. But we have some early evidence that maybe we have reached the peak in terms of the transmission of the monetary policy. If you look at the credit impulse, for instance, which has recovered from a trough, so which tend to suggest that it can be positive for sentiment going forward. And obviously, when the ECB continues to cut and reaching its terminal rate in 2025, this is going to be even more reflected in hard data.
Guy Johnson's been having out his marker pens this week to kind of underscore the point that the markets are really bad at predicting politics. And we've seen that in India, we've seen it in Mexico, we've seen it in South Africa. When the election's taking place, the kick-off in the Eurozone today, kicking off in the Netherlands, when you think about politics in Europe and how that evolves into your view, particularly around fiscal spending, we're talking about defence spending, whether they can align on that. How are you thinking about the linkages between the politics and the economy in the quarters ahead?
That's a very good point, and we remember when the ECB used to mention the fiscal policy that it has to remain tight in order for the monetary policy, in order for inflation to go back to target. We know that usually during election years we tend to see some fiscal slippage, but as you say, we know that there are big investment spending that is needed in Europe. So defense spending, you mentioned, climate change, and so on. And here on this front, it might be a potential upside risk, and in that case, leading to higher neutral interest rates. So, which means that if indeed we have this support to demand and to activity, the rate cut cycle would start earlier than expected.
Been great to see you this morning. Thanks for stopping by to see us. The first time I've talked to you on air, so very nice to bring you onto the show. Sabrina, thank you very much indeed. Sabrina Hanish, Senior Economist at Pictet Asset Management, joining us ahead of the ECB. Tom, I think you make a really good point, though, about the fiscal side. It's brilliant.
Yeah, I'll take that.
Yeah, I've got my marker pen out. You get a tick in the box.
Yeah, it's all fair.
Because you see the Fed basically having to lean in on the fiscal side in the United States. Europe has massive problems right now that it's got to deal with. It's got to deal with the climate story. It's got to invest heavily there. It's got to invest in the rearmament program. That's going to be absolutely massive on the day when we talk about D-Day and the kind of you look at the kind of the scale of the operations that have been mounted in the past and the impact it had. you think about the scale of that, all of this is going to come together into some significant fiscal spending over the next year. We don't know how it's going to be paid for, but...
Well, that's part of the issue. That's part of the rub.
Yep.
So the echoes of history are certainly there in terms of what's happening with D-Day. The consensus, as Ollie Crook has been outlining for us, the consensus is that we need, across the parties, there needs to be a step up in defence spending. It's to your point, is how you do that. And how much
how much it costs.
How you do that, the cost, who pays for it, how you get that funding together across those 27 nations.
But then you'd spend the money, and that's that could have. And if it's internalised within Europe, i.e., we spend it within Europe, that rearmament programme could have a fairly massive effect. We're going to look at all the stocks that are moving this morning. We'll do that next. The ones I want to talk about this morning, certainly keep an eye on what's happening with ASML. The company has now overtaken LVMH as Europe's second largest stock. Of course, Novo Nordisk is out in front. We'll talk about that next. We'll keep you updated on what is happening in Normandy. We'll keep you updated what is happening at the ECB as well. We'll be live in both events throughout the morning. This is Bloomberg. 7:45 here in London, 15 minutes ago until the start of trading. Look, I think we're going to see a positive performance out of Europe this morning. You've obviously got the legacy coming through back out of the United States yesterday. Asia's responded fairly strongly as well. We are now waiting for, though, the major events, which are coming up a little bit later. Clearly, the ECB is going to be one of them. Don't ignore the claims number today out of the United States. That's going to be interesting, obviously, as we watch the labour market data into the payroll number out of the United States tomorrow. What's on the mind of our Markets Live executive editor, Mark Cudmore? Let's find out. Mark, we've got the ECB coming up. How big an event do you think this could be? I'm struck by the fact that we know we're going to get a rate cut today, but then actually it goes a little bit, it gets a little harder to call after that.
It definitely gets harder to call after that. And I think there's potential for the ECB to really matter today. I think if they do give clarity on a kind of plan for cutting rates after this, if they do kind of proceed with reasonable forward guidance, then I think that has an extra dovish impact. Not only does it set out, like, obviously what the rate cut path will be, but the fact that the ECB are sticking to forward guidance in a world where the Fed is very firmly moving into an extreme data dependence would be quite interesting. Unfortunately, I say all that, I think they might let us down. I think they might actually steal a page from the book of the Fed, go for data dependence, leave us a little bit nonplussed, and that would probably see euro-dollar drift a little bit higher.
OK, drift. How much volatility do you think we could see if they turn around and go, we don't know, we are going to keep our cards close to our chest? Is that perceived as being hawkish? And is that something that could potentially drive euro-dollar not sort of drifting higher, but sharply higher?
How much volatility do we get? I think a lot in the short term in context that euro-dollar has been exceptionally low volatility recently. So I think we might get two-way moves. I think if they kind of come out with that message, I think you're right, it will be hawkish. Euro-dollar can go quite a bit higher in the coming weeks, but it'll also be tinged with a little bit of disappointment that they're kind of fudging the message. They don't seem to have clarity. It'll seem like a little bit of confusion. So I think that'll cause some short-term two-way moves as well.
What's the setup into claims? What's the setup into tomorrow's payroll number?
I'm really interested in claims. I think, we have to be watching for a potential turn in the US economy. I am in the camp that the recent soft prints in the data is not a turn, and therefore we're going to stay in an OK US growth story. Not a brilliant one, but a solid enough one. And therefore, I think the positive backdrop for risk assets sustains. But the jobs market will be really key if we want to change that. Obviously, we've got initial claims, but then non-farm payrolls tomorrow, I think, is exceptionally exciting and does have the possibility of changing the narrative.
OK, the exceptional assignment of the non-farm payrolls tomorrow with the date, of course, and the data coming through on Friday, US time for us, and how that ties in to expectations around the Fed. And it's the expectations around interest rates that is at least part of the story, as we see yields generally lower across treasuries, that is part of the story around technology. This is a chart that really caught my eye. So this is Nvidia. We know the market cap crashed through, burst through 3 trillion yesterday. The stock is up 150% year to date. Jensen Huang's personal net worth increased 5 billion yesterday, just in a single day, $5 billion US. But if you combine, Mark, the market caps of Nvidia, Microsoft and Apple, you're above 9 trillion US. And guess what? That takes you above the market cap of the entire mainland Chinese stock market, which is still the second largest stock market in the world. Mark, is this a cause for concern? Does it tell us more about China, more about the tech story? Is this cause for optimism? How do you read into some of these superlatives when it comes to the role of AI and tech in these market valuations?
Yeah, when you see something so counterintuitive like that, you've got a second to say, is it justified? And if it's not, which one's broken? Is it those US stocks are too overvalued or China's too undervalued? In this case, I think that the bigger opportunity is China's stocks upside. Look, Nvidia, Apple, Microsoft are pretty incredible companies making large profits. Sure, they're expensively valued, and Nvidia in particular is expensively and optimistically valued that it can sustain kind of on this AI excitement. But at the moment, it is delivered on that excitement for the last few quarters. And Apple, has done it for many years. Microsoft has done it for many, many years. So these are very, very solid companies. I think we know that the China story has a massive risk premium because many people perceived it as uninvestable. It does seem to be turning around. And I don't think that close valuation will remain. I think that we will see China stocks open up a gap to those stocks at some point over the next couple of years. The exact timing of when that happens, I don't know. And it's not necessarily a trading trigger just because they happen to be aligned today.
It's fascinating to see that Chinese property stocks have now fallen 20% from their peak, despite all the expectation that actually maybe we'll see policy having an impact, which maybe we got too far over our skis on. Mark, the real takeaway from me this week thus far, and Tom's going to roll his eyes because I keep banging on about it, is the fact that we're all obsessing about central banks. We're all spending a lot of time talking about central banks. It's the ECB today. We're going to be obsessing about the Fed tomorrow with the payrolls number. Yet the thing that keeps tripping markets up is what is happening on the fiscal front, what is happening with the politics, what's happening on the policy front. Is the market spending too much time talking about rate policy and not enough time talking about the kind of the slightly harder thing to predict and price, which is politics?
Yes and no. So, yes, I think you're right that the fiscal side is the more important story. And, our colleague Macroman did an excellent article on this last night, just talking about the US's fiscal problems and about it doesn't matter who wins the presidential election this year. It still doesn't look good for the US fiscal situation. And if the US has a fiscal problem, well, then lots of other countries are going to too. So I think this is going to be one of the dominant themes in the next few years, is that side. But, Guy, you also identified the other part of the story of why, no, people aren't wrong to instead focus on rates. Because as you outlined, it's a big backdrop picture that's hard to identify the timing. It's hard to trade in the short term. It doesn't matter till it suddenly does. And until it suddenly does, rates are the bigger drivers in the interim. So the markets are not wrong to spend more time in rates now. But they need not to forget about that fiscal story. For the last multiple decades, we've had warnings of those fiscal concerns, and they've normally proved to be false alarms. And it's like the boy who cried wolf. Well, you know what? At some point, fiscal problems do matter. We saw that with Liz Truss in the UK. And at some point, it will matter for the US and Japan and other countries as well.
OK, Bloomberg Markets Live Executive Editor Mark Cudmore, thank you very much indeed, with, of course, the analysis. Remember, you can get more up-to-date takes, of course, and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. To the stocks to watch today, then, and this was what of a mover yesterday. ASML adding 8%. The stock was up about 8% by the end of the session. It is now the second most valuable stock in Europe, just below Novo Nordisk and above LVMH, because guess what? It actually makes something useful. That's the market cap, $377 billion US for ASML. Bloomberg Intelligence crunching the numbers. The importance is they've shipped these high NA extreme ultraviolet lithography machines, one to Intel. Now TSMC says it will take one. Bloomberg Intelligence saying that could add 700 million euros to the earnings picture for ASML this year. And then next year is looking brighter. Again, that's their take. But it was the news around TSMC, who had originally balked at the price of this thing, which is above 300 million, suggesting that they are going to be taking on board one of these extreme ultraviolet machines, the most cutting edge, of course, at the end of this year. So watching ASML, see if they can build on the gains, up around 40% year to date, up 8% yesterday.
And this is why Tom Mackenzie is not our fashion correspondent.
Exactly.
Useful things. Lithography equipment is a useful thing. It's hard.
Statement of fact. Yeah.
It's hard to deny that. Atos extending its deadline for its restructuring programme into next week. I don't think, certainly the indications are that we're going to see any kind of movement on that stock. So kind of just sort of put that in your diary for next week. Remy the numbers are out this morning. Now, the initial read certainly seemed to be that Remy Cointreau was likely to see a negative hit off this. The pricing I'm seeing suggests that actually Remy may open higher this morning. So relative to expectations, despite what we're seeing, maybe actually the market is going to mark this stock a little bit higher. So just keep an eye on that one as well. There's some interesting other stocks that are worth watching this morning. Norwegian Air could be one of them. It's seeing significant capacity increases across Europe this morning. So just keep an eye on maybe that one as well. But Remy looks like it could open higher. Anyway, the stocks are going to be interesting today. I think Remy is certainly one of those, and we'll see how it opens. But we come back to the ECB. I think they're in the building. They're talking about what policy is going to look like. They're talking about what policy will look like further down. I wonder what the debate is looking like around the table.
Well, I wonder how raw it is, because there are divisions. There are clearly divisions between the hawks and the doves. They've been long-running and well-pronounced, of course. And the other question is, to what extent will this be a catalyst if you just get one cut? The flag, of course, coming from Christine Lagarde later in terms of the guidance, in terms of the catalytic effects for these European equity markets. Do you, for example, sell banks and buy real estate on the back of this? Is that a clear trade? All of this, of course, we're going to do a deep dive on. Lizzie Burden is on the ground for us in Frankfurt.
This is what it looks like in Frankfurt. They're all in the building. This is the building in which it's happening, that kind of iconic Euro sign, which used to be further away over in Frankfurt. They've rebuilt it inside the ECB. Lizzie Burden, as Tom says, is going to be bringing us coverage throughout the morning. Equity markets are about to open in Europe. We'll count you down to that event as well. But that's what Frankfurt looks like right now. The ECB is the main event. Thursday, the 6th of June, good morning. Equities are about to start trading here in Europe. I think it's going to be reasonably muted until we get into the ECB. There's a few single stocks that you're going to want to pay attention to, but it feels like we're in a kind of macro run right now. You've got the ECB today. That's going to have a meaningful impact. Then we get into claims a little bit later on. Pay attention to the labour market data out of the States. We're going to be moving, of course, into what happens with the payroll number tomorrow, Tom. That's going to be pivotal as well. I think Remy's going to be interesting to see how that opens this morning. You're obsessed. I'm allowed to use that obsessed because apparently you've told me I'm obsessed.
Yes.
You're obsessed with ASML. It's a useful company.
I mean, the lift that it saw yesterday, upside, more than 8% gains for ASML. It is a useful company. It makes things that are useful, unlike LVMH. It has topped LVMH. This is one person's opinion. That's not necessarily mine.
If anybody from LVMH is watching, there are other opinions.
I should put these interview bids in now for the LVMH executive team. I think I'm winning on that front. ASML, so the second largest market cap company in Europe, because yes, it makes these extreme ultraviolet lithography machines. It has that monopoly, TSMC taking charge. So we watched that. We watched the semiconductor space again. Nvidia, of course, charging higher yesterday, making up for about 28%, I think, of the gains of the S&P. Bigger than Apple, with a $3 trillion market cap.
It's amazing. How many companies have achieved that? I think it's 3 companies have achieved that. 3 or 4.
2002, it was worth $10 billion. It was worth $10 billion. That was the last time it was about the same size as Apple, before the iPhone, 5 years before the iPhone
It's one of those stocks that you have to press, when you go to the GP chart on your Bloomberg, you have to press max. just to kind of appreciate the scale of the gains that we've been seeing. But to your point, ASML was up 8% yesterday on this TSMC story, plus the Morgan Stanley upgrade. Really giving that stock a huge boost. So here we go. European equities are about to open Thursday, the 6th of June. What kind of a market story are we going to see into the ECB meeting a little bit later on around lunchtime? Here we go. We're going to start to see trading unfolding in front of us. And initially, Novo Nordisk looks like it's popping higher as well, just in terms of the percentage gains. That's fascinating. So it already is adding by far and away the bulk of the points gains. Novo Nordisk and ASML, there you go. Those are the 2 biggest stocks in Europe, and they are leading in terms of points, understandably. But the percentage gains are pretty strong as well. Can I just throw in the fact as well that the 3rd biggest points gainer this morning is LVMH? But that's not useful. I'm going to
pass that. Here's another redhead also, just switching focus to the energy story. Do you remember when the traders at Trafigura were just minting cash during the crisis in Ukraine? Well, half-year profit, this is redhead on the terminal right now, Trafigura half-year profit dropping 73% as the energy crisis fades. Bad news for traders there, good news for the rest of us in terms of inflation, of course. So, yes, technology, healthcare, tech, still the leading sectors. The upside coming through 0.5%. And again, we're talking about the ECB, the cut that's expected to come through today, and what that could mean for European equities as the rally continues.
Absolutely. There's probably some ex-divs in the market as well, so I'm just going to be a little cautious when we come to the downside as to what is happening. But it is interesting that we talk about the kind of the Magnificent Seven and the impact that they are having here over in the United States. Here in Europe, I am confounded. I continue to be confounded just by the kind of the scale of the impact that these small group of stocks are having. LVMH, LVMH, not LVMH, Novo Nordisk, ASML, Schneider's on the list as well. It's up quite strongly again this morning. So you've got these big stocks, these big kind of impact stocks really having that impact today. And it's interesting so what kind of trading is going on? This feels like this feels like the story that we were watching recently, which is the passive money just pouring into these kinds of stocks. And that looks like it is the kind of momentum story here in Europe, and it doesn't look like it's letting up anytime soon.
You flagged that Remy might be a mover, and it is up there as one of the key gainers, the top gainers so far in the session, up 3.5%. The top line was that they actually beat in terms of their earnings. There's still a challenge in terms of the demand picture, as you mentioned, around the US. They've seen some improvements in the Chinese market. Top line is they beat, and Remy is now the leading gainer. So far, early doors, of course, in terms of the European session, up 4% so far on Remy, just shy of 4%.
It's ECB Day.
Yeah.
That's what we're watching today. That's the big story that we're going to be watching for a little bit later on. Conor Cooper from Bloomberg's MLive blog sitting next to us now. What do you expect? I'm getting excited about this. Should I be?
Not about the rate decision, no.
No, we know that's coming, but what comes next?
So what next? Is this a central bank that's keen to cut rates again, or is this a cut-and-wait approach from the ECB? The way market pricing is, the ECB is going to cut today, they're going to pause in July. That's not a bad position for the ECB to be in. It means they can wait till September to get 3 months more of data, wage numbers, which we're told are really important. They can regroup. So it's probably going to be a boring, data-dependent message from Lagarde. I imagine any questions on where rates go next will be pushed away with data-dependent, data-dependent, data-dependent.
I can't believe you just put a cap on Guy Johnson's excitement around the ECB.
I think that's quite interesting, because I wonder how will the market perceive that as being hawkish. Is this a hawkish cut, I guess, is maybe... You read into that as being a hawkish cut, right?
Yeah, and whether or not, again, you've talked about the potential volatility around the euro on the back of that. When it comes to the Fed, then, we had ADP data. Services came in strong. The jobs market does seem to be cooling. Manufacturing is cooling. We have non-farm payrolls on Friday, of course, and how that builds into the picture. Where are we in terms of the market's now pricing in, almost fully pricing in 2 cuts now from the Fed?
Yeah, I was checking this morning. There's 48 basis points for cuts priced in for this year. It was 30 basis points last week. It started with that down revision to first quarter GDP. We had a miss in JOLTS, a miss in ISM manufacturing. Services did beat, but prices paid tick lower. And if you look at the market reaction from yesterday, yield shot higher on the headline number, but then they saw the prices paid and become lower again. So Fed goes into this meeting with data sort of on the turn lower. I don't think they've made their mind up yet, because we have payrolls tomorrow and we have CPI on Fed Day as well. So I don't think that will change if we get a rate cut or not from the Fed. I do think they'll be on hold. The messaging, I think, will depend on the jobs number tomorrow and the CPI data we get a few hours before the Fed.
Are equity markets responding to the idea that rates are coming lower? Because I found it really... Equity markets continued to go higher when we were pricing out cuts, so why should they go higher when we price some of those cuts back? I'm finding this slightly difficult to understand.
I had the same theory. I mean, there's no stopping Nvidia at the moment.
No.
US stocks, they look like they're going along for the ride. Record highs for both the indexes yesterday. It takes a brave person to call when this euphoria will sort of end. Nvidia don't seem to be stopping. They had a new product announcement just this weekend, I think.
Yeah.
And like you said, in the pipeline is accommodative monetary policy. This is a stock that's gone sort of parabolic during the most aggressive hiking cycle, or one of in history.
It's amazing.
It's kept on going while rates have stayed high. I don't think more accommodative policy is going to be the catalyst for a lower move for Nvidia.
And Goldman Sachs, interestingly, talking about the cash that's on the sidelines and how typically that gets put to play over the summer months. What derails this rally, though?
Maybe does the Fed go too far? I don't think we'll know this until after the fact, which is a problem for the Fed. There might be a concern that the Fed's sort of too aggressive. Inflation comes too low and sort of derails the recovery.
If the dot plots and the forecasts come in at 1 from 3 to 1, does that challenge the equity markets, or do the stocks just look through that as well?
Again, stocks have rallied, like I said, during the most aggressive hiking cycle in history, and they've still rallied when we've held it there. I mean, when they was predicting this aggressive path of rate cuts, everyone was calling the sort of death knell for equities, but they kept on going. And now they've got these sort of the Nvidia AI catalyst to carry it on. So I think unless the Fed goes ultra aggressive on raising rates again, if inflation re-accelerates, I think the path is still high for stocks.
Yeah. It's interesting that the bond market's maybe seeing the world, starting to see the world a little bit differently. that relationship's going to be fascinating to watch. Great stuff, Connor. Nice to see you. Thanks very much indeed. Connor Cooper joining us from our MLive blog. Let's talk about Remy. Let's talk about what's happening in the drinks business. Remy Cointreau shares gaining this morning. Decent bounce, as you can see, up by over 4%. The French cognac maker beating estimates on full-year operating income. Says it's going to take another year, though, to return to growth. The initial headlines I saw this morning, I have to say the initial read looked a little bit more downbeat. It's going to take a while longer to get things back on track, but actually maybe doing a little bit better than anticipated with the current numbers is enough to drive the stock. It's been moving lower, obviously, for a while. Duncan Fox from Bloomberg Intelligence joins us now. Look, what have I learned today that justifies the bounce, and what happens next? It still feels like it's a company that is in cautious mode.
It is, but it's looking for the long term, and it's confirmed its sort of 2029, 2030 guidance, where gross margins up at 73% and net margins considerably higher than they are today. So I think that was very important. And you've got to remember the shares have been hammered this year so far as well. I think it's about 26, 27% down on the year. So there's a relief that it's not worse than expected, part one. And two, if interest rates start to go down in the discussion you just had, that would be very good news for the US business, because if you're a distributor, it's quite an expensive thing to buy a couple of cases, many cases of this cognac. So for the working capital side. Exactly. So I think interest rates coming down would be a big help for this company in the US, which is a very, very big market for them.
Yeah, OK, so we're tying the corporate and consumer story back to the rate story. Which of the regions is most essential to them right now? Whether it's China, there seems to have been made some progress in terms of cutting costs in that region, but the US marketing cost is a factor there. Which of those regions is most consequential, do you think, in the quarters ahead?
I think the US is the one that would matter most, because once you've got rid of the inventory from the system, then you should start to see people buy cocktails again if the consumers are confident enough to do that, and that will drive organic growth of the company. China is, they sell a lot of very expensive product into China, but they sort of got that where they needed to be. The only issue they've got there now might be if the Chinese anti-dumping program on cognac, or sorry, brandy, comes back to bite them. But I think that's more political than actual, to be honest with you. But I'm not good enough to quote on that one.
Be interesting to see what a Trump presidency could mean for the sector as well. Duncan, nice to speak to you. Thanks very much indeed for dropping by. Duncan Fox joining us from Bloomberg Intelligence on the Remy numbers. Let's take a look at what is happening with the Core 6 this morning. We've already talked about the fact that some of these stocks seem to be getting a decent bounce, and as you can see, it really is writ large across the board in front of you. Novo's up really strongly, pushing higher again. I think it's a fresh record there. The less than useful LVMH, I joke, of course it is useful, but it sits next to, well, near to ASML. Are Ferraris useful, Tom?
Oh, Ferraris definitely fit the usability. How many Birkins do you have now in the Guy Johnson collection? In that
three or four, but
3 or 4 Birkins,
I park them next to my Ferraris.
Keeping them in Ferraris,
We did obviously have the Danish market closed yesterday. I think Sweden's closed today, so just bear that in mind as well. So that market was closed yesterday. Schneider's up really nicely as well, but look, Nestle, a little softer today, which I think is interesting. But ASML continues to pound.
Yeah.
It was up, 8% yesterday. It's up another 2.5% today.
Yeah, that is not a small move that we saw yesterday. There's no profit-taking going on right now. We're adding to the gains, closing in on €1,000, up 2.4%. This is a stock that's rallied more than 40% year-to-date. And the key piece of news that seemed to come through, yes, there was an upgrade. That was a factor, but also the news that TSMC, which of course owns these foundries, will be taking shipment of one of the most high-tech lithography machines that ASML produces, with a price tag of above €300 million. So that's number 2 for them. They have Intel taking charge of one, taking ownership of one, and then TSMC. And the broader outlook then is you push into 2025 with Bloomberg Intelligence seeing that adds just for this year €700 million potentially for this company, and you look ahead to 2025, which the company had already said was going to turn more positive in terms of demand. So that story continues for ASML.
Remy, I'm just going through the usefulness scale here. Remy, useful there. It seems to be
in moments of crisis, moments of pleasure and joy. Yeah, it has a utility, doesn't it, I think? Is it too early to talk about?
No, I definitely don't think it is. But Remy's up nicely, nearly 4%. It's off its earlier highs, but yeah, the numbers look fairly good this morning. But remember, this is a stock that has had a fairly difficult run recently. So you've got to kind of put it in the context of kind of where we are, which is why I think the bounce this morning in ASML is kind of amazing, considering this is off an 8% bounce yesterday. So that stock continues to deliver on day 2, day 3, day 4. It's amazing.
Yeah. I now have an image of you with your Ferrari parked outside the villa in Surrey with that case of cognac and the Birkin bags, Guy Johnson.
You know me so well.
We're talking about the FTSE 100 reshuffle. Well, that's happening today. Bit of a blow for Ocado, but maybe a little bit of upside for some real estate companies. So the reshuffle, quarterly reshuffle, kicking in today. UK landlord London Metric, cybersecurity firm Darktrace, and home builder Vistry are being promoted to the top benchmark. Meanwhile, Ocado, as I mentioned, getting relegated into the relegation zone to the FTSE 250 for the first time in 6 years. Along with them, wealth manager at St James's Place, which has had its own challenges, of course, this year, and electronic components maker RS Group. For more, we are joined by Morwenna Conyam from Bloomberg Markets Today blog. Morwenna, talk us about some of these moves and what it tells us maybe about some of the idiosyncratic stories within these individual companies.
An interesting selection of companies. I think London Metric, the UK landlord, that has really been helped by their takeover of a rival this year. And that's actually seen its market cap almost double, which of course puts it within the catchment area, so to speak, for the FTSE 100. Then if you look at something like Ocado, I don't think there's any surprise that it has been moved down because it's actually lost about 50% of its share price in the last year. But there is an interesting question with Ocado in the way that it's been valued. So investors have been disappointed in how it's got new contracts for its warehouses, but it's also been valued as kind of as a grocer in the UK. Some people would like it to be seen more as a tech company, so that's always been a bit of a controversial stock for the UK. Then looking at other stocks that are moving, we've got Vistry, which is a home builder. Now that's an interesting one because it's basically going up because they think there's better signs of growth in the UK housing market. But of course we know that that's quite volatile. We also have an election coming up this year, so those stocks that are impacted by macro factors, whether they manage to retain that growth is up.
So how much? Okay, so balance those two things out for me. How much of this is about idiosyncratic single stock stories that are moving these stocks in and out of the FTSE 100, and how much of it's this kind of broader trend as to what is happening in the market?
I would say most of them are actually quite idiosyncratic. If you look at things like St James's Place, they have had very well publicised difficulties, and that's. But although they've also been benefiting actually recently from increased inflows since they've sorted some of them out, but it's too late for the shares, so to speak. And then you've also got RV, that is more of a sector-wide issue with supplies, and Darktrace, that's again
Darktrace being taken over?
Yes, so that's actually a really interesting one because it's although it is entering now, it has been agreed to be taken over. So
is it entering because it's got a premium because of the takeover?
Well, it has risen because of that. So I think it'll be interesting to see what happens next time we get a reshuffle because that stock won't be there anymore.
Thoma Bravo, right, the US private equity firm. Agreeing to take over Darktrace.
It seems slightly weird that you're promoted into the FTSE 100 because you've got a big premium being attached to your stock because you're being taken over, and then you're going to leave. So that sounds a little curious to me. Anyway, nice to see you. Thanks for dropping by to see us. Morwenna Conyam joining us in the Markets Today blog. I want to leave you, we'll be back in a moment, I want to leave you, though, with the shots coming out of Normandy. This is the American cemetery in Normandy. It sits just, of course, behind Omaha Beach, where 80 years ago today we were seeing huge amounts of fighting. The Americans were fighting their way ashore right now. A little later on, we are going to be seeing the president arriving. I think he's going to be arriving on Marine One. We'll see him touch down a little bit later on. But you're looking at live pictures coming from just behind the Normandy beaches, where 80 years ago today we saw some of the fiercest action of the Second World War, and obviously a huge day for Europe. We'll bring you live pictures as we continue to mark that coverage today. This is Bloomberg.
A lot of adjustments in the market. I think to your question, the first phase of that was, really banks backing off, being more, I would say, more judicious with their balance sheets in a way that took committed credit financing out of the market, which made it hard to transact. Private lenders, certainly to some extent stepped into that stepped into that breach and were available, but quite expensive. And I think that caused a lot of challenges to buyers and sellers meeting in the transaction market. I think we are moving through that transition. You know, private credit markets continue to function, but the bank lenders are coming back as well.
Chris Gordon, co-head of global private equity at Bain Capital, giving his view on the shifting relationship between lenders and investors over the last few years. Kriti Gupta is on location for us, of course, at SuperReturn today in Berlin. It is the world's biggest private equity event, and we cross back over to Kriti with another guest. Kriti.
Yeah, Tom, thank you. And that piece you just heard from Chris Gordon, he's talking about lenders coming back to the market, that mismatch that you're seeing, and really how those higher interest rates are perhaps pressuring the dynamic between private credit and private equity in terms of getting these deals across the finish line. We've got a great new voice. Chris Gordon, they're giving the private equity voice. We've got a private credit voice as well. Cecile Mayer-Levi, head of private debt at Tikehau, joins me right here in Berlin. A pleasure to have you on the program, Cecile. Thank you so much for joining us. We were just talking about that kind of mismatch. We heard it from the private equity view. We're talking about lenders coming back to the market. Where's the hesitation? Do you see that ramping up?
Well, thanks for having me. I'm very pleased to be with you today. I will say that this private debt concept emerged on the background precisely of credit violence back at the time of the GFC, and today, so that's really highlighting the key merits of this asset class, where we see the dialogue with the private equity and the private lenders being more and more intense. On the background of the high interest rate, of course, there are some tension that you can feel, and there were some, in a way, also view that because of the global market, the liquid market, the high-yield market being shut down since mid-22, the private credit was really the go-to market, and therefore there have been more and more solutions solved thanks to private credit. But now we are also at this stage where we do see the legacy with portfolio impacted by high interest rate and therefore coming to some pressure, and where you need to work out, and you can in a way feel some maybe violence, or I would say more active dialogue, where you need to find solutions. But at the same time, the current environment makes it easier because all those negative factors are integrated in the underwriting, where so we hope and we are very convinced that the current cycle will be excellent because you have integrated again this high interest rate, and the leverage has been going down, and the private equity are now aware that it's fine not to have very high leverage type of deal. So that's the good news for us, that it's a more balanced and better landscape.
So tensions, violence, a little active dialogue. Who doesn't love a little drama? I certainly do. When you add in the fact that the leverage loan market in Europe is actually opening up a bit, what does that do to spread compression?
Well, yeah, it's an interesting question. I would say that the very fact that you are asking this question at a private equity, private credit conference is really highlighting the fact that those markets are more and more intertwined now, because we will never speak about a spread compression for private credit, which was a very, by its name, privately held. And now we do see the frontiers becoming blurrier, and no more difference between this pendulum effect going from the public liquid market to the private market, and just for one of the very basic reasons being that the private credit has grown so dramatically over the past 5 years, from a 500 billion overall size back in 5 years ago to currently we say 1.7 trillion, and so meaning that it has become one of the solutions, and you see this public market going up and down, and the spread compression is really reflecting this kind of interconnectedness between the market. We will, in the past, have never seen this contamination, and now you see, because of public market reopening, the CLO market being much more active. Therefore, there is some competitive pressure going down on the private credit as well, and that's very reactive. And also, in a way, contamination from US to Europe, because the US are usually always ahead, but in a way that's, again, showing that those markets have become much more efficient, growing in scale.
So one of the big concerns here, and I'm hearing this in the conference, across various players, from the banks to the lenders to the equity folks as well, not to mention simply the PR folks that are really kind of pitch some of these guests to us, is that deal flow is picking up, activity is looking great, the pipeline is only getting bigger to fill that void that you were just talking about post-GFC in terms of financing. Except it feels like the problem as well is what that return of distribution actually looks like. No one seems to time that out, and the backlog is only getting bigger and bigger. I've heard that people are waiting for the capital markets to open up. They kind of already are. What does that look like for you? When can we expect those returns to really ramp up?
Yeah, well, I guess the big key takeaway of this conference, I would say, is this notion that performance dispersion is going to at last arise, and that you will see some difference with the private equity firms who have been in detail and really ending properly their equity story and not relying only on the market and the multiple expansion. We will be at this intersection in the market where in a few years, and I'm expecting this in 2 years, to be able to see the differences with the and in terms of performance dispersion.
All right, Cecile Mayer-Levi, we have to leave it there. The head of private debt over at Tikehau. Tom and Guy, this is a really important conversation. That return investors are going to get, can they ultimately deploy it in the public markets? That seems to be the question right now, right here in Berlin.
Kriti's having fun in Berlin. Some great guests coming out of that SuperReturn conference. We'll bring you more coverage from that event. SuperReturn continues throughout the day. Guest highlights, we've got Joanna Barr coming from Advent International. You've got KKR's Peter Stavros. Tomo Bravo is going to be joining us. We've got the founder of Tomo Bravo, Orlando Bravo, is going to be joining us. That is a great guest. You're definitely going to want to tune in to hear what he has to say a little bit later on. I want to leave you, though, with a live shot. We're coming out of Frankfurt today. We've got some great coverage lined up of the ECB event that is going to be taking place. We're obviously going to see that interest rate decision coming out. The key story, though, that you want to be watching out for in some ways is not the rate decision, Tom. It's what comes out in terms of the staff forecast, and it's that press conference. What tone does Christine Lagarde put on today's decision? And what comes next?
Yeah, as you said, could it be a hawkish cut from the ECB? We listen in to Christine Lagarde and, of course, the update for the forecast around inflation and growth as well.
So there's a great live blog that's going to be running throughout that event. You want to make sure that you've got that up on your Bloomberg terminal. We'll obviously have the press conference for you live. We've got some great coverage coming up as that event kicks off. Markets Today live blog as well. If you want to tune into that too, that is going to be worth watching. The T-Live, though, out of Frankfurt. There's Frankfurt. We'll take you back there shortly. This is Bloomberg.
This is Markets Today. We are 30 minutes into the European trading day. Of course, when it comes to the macro story, central banks, we are waiting for that ECB decision, expected cut, of course. But also in Europe, another moment of history, more significant, arguably, of course, 80 years, the anniversary, of course, of the landings in Normandy. We're getting live pictures right now from the American cemetery in Normandy, of course, around this date, 80 years ago, 156,000 Allied servicemen landed on those beaches in Normandy. There were, of course, significant casualties, around 10,000 casualties on the Allied side, around 6,000 to 9,000 on the German side. There was something like 7,000 vessels involved in these operations. President Biden, we know, will be on the ground any minute to mark this, of course, 80th anniversary. Guy.
Yeah, we're expecting him. We're expecting the imminent arrival of Marine One. He's been in Europe for the last few days, but this is the sort of the culmination of this event. It's really interesting. I was talking to a number of kind of airline and CEOs and CEOs over the last few days. They're all there as well. I was talking to Ed Bastian, the CEO of Delta. They've had this big program to fly veterans over for the anniversary. Obviously, many of these people are getting on in years, and the 80th anniversary Obviously, a huge event for them. He was talking to me about one guy who he's one of the youngest guys there. He basically kind of went in underage and went to the beaches, and they're flying him over. But I was talking to the CEO of Boeing. I was talking to the CEO of United. All these guys are talking about this as being a really big event for American businesses. They see this as being kind of one of the pivotal moments of kind of passing of a generation. And one of the last times we'll be able to do that.
And there are, of course, echoes of history in what we're seeing right now in terms of the conflict, Russia's invasion of Ukraine.
About that. I have to, it was interesting talking to Dave Calhoun about this. He was talking about the parallels. The first time he sees those parallels existing.
Putin not invited, of course, to the 80th anniversary, and many would say for very justifiable reasons. But of course, the Red Army had a key role to play, of course, in the ultimate success in terms of the conflict against the Nazis.
And the Russians were very keen on making sure that this was the second front that they pushed for so strongly to make sure that the German forces were pulled in two different directions. Let's pivot to a different story that is taking place in Europe, and that is the ECB today. We're going to be watching that very carefully, trying to understand exactly how the market is going to react to whatever it is we get from Christine Lagarde a little bit later on. Let's get an insight into what is happening with this. We join now Bloomberg's Ven Ram, part of our Markets Live team. Ven, just give us what's the setup into this event? We know that we're going to see probably a rate cut today, but what we don't know is what comes after that.
Absolutely, Guy. I mean, it's going to be a do something but say nothing meeting virtually from the ECB, because they've painted themselves into a corner about a rate cut for 3 months now. So the decision itself is very, very well telegraphed. But the question for investors, as you suggested, is what's going to happen beyond today? Are we going to get one more rate cut in the rest of the year, or are we getting 2 more rate cuts? The markets aren't quite sure. They're pricing in 1.5 rate cuts. But I think that in the event that the Fed doesn't go, I think there is a possibility that we get just one rate cut in the remainder of the year. That will be a key question for the markets. The other key question for the markets is, where is the ECB's terminal rate, and where is the ECB's neutral rate? And I think Lagarde is unlikely to give us any clear-cut answers on those, because she's been asked about it before and she has never given a thinking about the ECB's neutral rate. But research from the ECB shows that the neutral rate has risen by about 30 basis points since the pandemic. And if you look at the Taylor rule rate, Guy, it suggests that the ECB rate ought to go down to 2.2%, given their macroeconomic projections. But if you look at the market pricing for October 2025, they're pricing in only 2.75. So there is a fair bit of skepticism between where the Taylor rule posits the rate should be and where the market is. And that gap needs to close at some point.
Yeah, at some point. The Taylor rule is a guide, I would argue, maybe as other markets, maybe as well. But it's the speed at which that happens, then, that is going to be critical. And it's that rate of change which I think is going to be fascinating to watch, because that could potentially have a meaningful impact in terms of the outlook for the euro. How much volatility do you think we're going to see around today, and how much volatility do we think we're going to see going forward? Because this has been a low vol environment for quite some time.
Absolutely, and if you look at the realized vol on the euro, we haven't done very much at all this year. In the entire 2024, we haven't done much of a range. So I think that will continue. I mean, we may see a 0.2 to 0.3% move in the aftermath of the decision and comments, but that is likely to wither as the days go by. What is crucial for the euro is going to be the dollar side of the equation. And if you look at all the moves in the euro so far, it's been pretty much dominated and come from the dollar side of the equation rather than the euro side of the equation. And that is bound to continue. Why do I say that? Because if you look at inflation-adjusted rates, which is key for the markets, they've moved a whole lot in the US and not so much in the Eurozone. And that is going to continue to be the case. We saw the volatility associated with the ISM services numbers yesterday. And clearly, I mean, the economy in the US is moving in the direction that the Fed wants it to move. but they're not clearly at that stage where they are going to say, you know what, we are convinced that inflation is going to converge to 2%, let's cut rates. They are not going to cut rates. So the dollar is going to be in a position where it is supported, well supported, and the euro is just going to tread water from here in the couple of months, in the couple of months at least.
OK, euro-dollar currently at 108, just up 0.1%. Ven Ram from Bloomberg's MLive team, of course, with the analysis as we lead up to that ECB decision. Ven, thank you. Talking of which, we are live, of course, from the ECB in Frankfurt ahead of that rate decision later today. Lizzie Burden on the ground for us. We're going to get another preview for you next. This is Bloomberg.
Thursday, the 6th of June. Good morning. This is how European markets look as we open trade this Thursday. As you can see, a fairly positive picture that it continues. And we continue to see strength in some of the core stocks. You're looking at a solid day today for LVMH and for ASML and Novo Nordisk, which has reopened after the holiday yesterday. These are the stocks that are driving Europe today. Let's talk about what the agenda looks like for the rest of the session. 1:15, obviously, we get that. This is UK time. We get that ECB rate decision. We'll obviously break that for you. We get the press conference afterwards. We'll bring you that live, definitely here on Bloomberg TV. Claims data out of the United States. Keep an eye on that. That's a pivotal piece of data. It's a weekly data, but we come into the payrolls number tomorrow. And it is, of course, the D-Day 80th anniversary. Those events are already underway in Normandy. We are awaiting the arrival of President Biden in Normandy. Marine One should be touching down very shortly. He has left Paris. EU parliamentary elections begin. The bulk of that takes place this weekend. And Kriti Gupta is enjoying herself in Berlin today. She is at the SuperReturn conference, which, of course, is the largest private equity event of the calendar here in Europe. And we're going to be watching that one a little bit later on. Some great guests coming out of that. And we'll continue to bring those guests throughout the morning. The main event, though, from a markets point of view today, though, is the ECB. Expected to start lowering rates. The first time we've seen a depot rate cut since 2019. Is inflation really moving in the right direction? Critically, is inflation moving in the direction fast enough? Let's try and get an answer to that question. Lizzie Burden is in Frankfurt. She's inside the ECB to set things up for us. Lizzie, what are you expecting?
Yes, Guy, they have let me in. And as you say, it's a historic day with D-Day in mind. It's also historic for monetary policy. It's the first time in history we expect that the ECB will cut interest rates before the Federal Reserve. But this cut today has been well telegraphed. It's fully priced into markets and it's almost unanimously expected by economists. So the focus, Guy, not so much on what happens today as what they say about the rate path ahead. And doubt has been cast over that recently because of the latest economic data. You've got inflation sticky, wage growth rapid, and particular concern from officials that represent Northern Europe about the need for caution going forward. So in terms of the clues, of course, we'll listen to Madame Lagarde at the press conference, whether she tells us that cuts might be quarterly or whether she sets a cadence of a pause after June and a return to data dependence. And then we'll look at the forecasts. Do we see inflation hitting target in 2025? That's what's expected. But then in 2026, do we see an upward revision? That would suggest that there's a higher bar for cuts going forward. Interesting also from an equity perspective to look at growth. Do we see an upward revision? Be good for cyclical stocks.
How is the debate, you touched on this, Lizzie, how is the debate evolving, do you think, amongst those ECB governing members when it comes to the inflation story in Europe and whether or not they really have broken the back of it? If we think, for example, about the uptick that we've seen in the US and the cause of concern that has led, for some Fed officials at least.
It's that traditional north-south divide, Tom, where the caution is being called for from those who represent the north versus those in the south of Europe. You've had the likes of the hawks on the Governing Council, like Isabel Schnabel, Joachim Nagel, kind of ruling out a July cut, and Robert Holtzman saying actually 2 more cuts in 2024 may suffice. So there is this division in terms of the path ahead. In terms of the divergence between the ECB ECB and the Federal Reserve. It's interesting that the conversation has evolved since the last meeting because of this change in the economic data, the suggestion of a persistence of services inflation, domestically driven inflation because of wage growth. Does this problem persist going forward? It has led many to think that actually there are more parallels between the two sides of the Atlantic, even if they had very, very different origins, these inflation crises. In the US, of course, it was massive fiscal stimulus. Here in Europe, it goes back to the energy crisis after Russia's invasion of Ukraine.
Lizzie, looking forward to the coverage throughout the day. I know you'll be walking us through all of the events as we build up to the decision and also then the press conference. I just want to point out to our audience that President Biden just walking off Air Force One with the First Lady, arriving in Normandy. My understanding is that he will now board Marine One and be flown into the event that is taking place at the American Cemetery just behind the beaches in Normandy. But President Biden arriving in Normandy, just stepping off Air Force One with the First Lady, and they will now be making their way towards that event, just boarding Marine One, and we'll continue to keep you up to date with what is happening as events unfold in northern France today on the 6th of June, the 80th anniversary of the D-Day invasion. Let's turn back now to the ECB as we watch the President and the First Lady board the helicopter. Fabio Barbodi, senior economist for the Eurozone at HSBC, now sitting next to us. Fabio, we're juggling events here in Europe. The ECB obviously critical to financial markets, and we are going to continue to sort of build up and get excited about this event today. It is the first time since 2019 that we've seen the deposit rate potentially being cut. How critical is this? How big an impact is this going to have on European growth?
Well, I don't think the cut itself is going to have a huge impact. In fact, this is largely seen as an unwinding of the insurance hike that they did in September. So I think, as your colleague was saying before, it will all about the signaling about possible future cuts. And there's maybe a first level of understanding of the meeting that will be whether they retain the easing bias in the current statement, so where they say that if inflation evolves according to our forecast, we want to reduce the restriction further. And then the second level is whether they change the forecast, of course. And we think they will change it, they will revise up inflation, but we don't think they will change it fundamentally further out, 2025, 2026.
So when does the next cut come?
So in our view, the next cut comes in September. I think the recent inflation data a little bit stronger, but also growth showing a little bit more resilience makes it very difficult for the ECB to move already in July. But we do continue to think that inflation being on a downward trajectory should allow the ECB to cut rate further. And when you think about the ECB, you have to think about a central bank that has a lot of inertia in the way the kind of the monetary policy decision work. So it takes a while for them to kind of process new information, to change. Often we find that at every meeting they discuss more the next meeting rather than the meeting itself. So we think that, unless inflation surprises significantly to the upside over the summer, we think they should cut at least another time in September. Our forecast actually is that they will cut 3 times this year, December as well. But obviously I think an interesting element will be to what extent today we're going to continue to see that strong consensus, even among the hawks, that conditions are restrictive, because really so far that consensus hasn't been undermined. And it'd be interesting to see whether some of the latest data starts to unravel a little bit this situation.
OK, so both the guests on our show today expecting 3 cuts this year. We were speaking to Vanguard and the economist there earlier this week, projecting and expecting rates for the ECB to be down to 2.25% by the end of next year. As you project out to next year, where do you see rates?
So we actually have the ECB stopping a little bit earlier, 2.5%. Of course, the discussion about terminal rate is at very early stages. There was an interesting initial suggestion by Schnabel board member that maybe R* was higher in the Eurozone, but we've seen quite a bit of pushback on that, including from some of the hawks on this idea. So in our view, the ECB will have to cut rate further. There's also a fiscal problem for many countries that it's difficult to kind of make the debt look sustainable if rates remain so high. So we think that could also play a little bit of a part. And fiscal policy in itself is important, because we're not looking for a fiscal expansion next year in the Eurozone, but rather a little bit of tightening. Fiscal rules are coming back. So that should also help the ECB continue to cut rates a little bit more into next year.
The rules come back 2025, bit of fiscal tightening. That's despite what happens over the elections that unfold over the next few days. What does that do to your growth outlook then for the Eurozone?
Well, that's why we retain a growth outlook which is fundamentally a little bit below or just around potential. So we have processed, of course, the latest news. There have been a little bit of an upside surprise in terms of Q1 growth, of course. But when you look at the underlying growth momentum, we still remain fairly cautious. We think that maybe not all of the monetary transmission has already been worked its way through into the economy. We think there's still a little bit that needs to come. And as such, I think, it's unlikely for us that we're going to be significantly surprised to the upside on growth. And that is an important part of our ECB story, because I said before, if suddenly we do see growth surprising significantly to the upside, that could actually start a little bit more of a debate, like in the US, where the R-star is higher, and therefore whether the ECB does actually have to cut rates so much.
Can I just talk a little bit about what's happening in more detail with the fiscal story? And maybe actually more detail is the wrong way of putting it. Europe has a lot of spending to do. It's got to navigate the energy transition. We've seen the impact that energy has on our economy over the last few years. On the day when we're looking at what is happening in Normandy, we've got a lot of defence spending that we've got to do as well. Now, we don't know how all of this is going to be funded. We've also got big welfare bills that we've got to feed as well. How do you marry up what is going to happen on the fiscal front over the next few years and the amount of money that is going to have to be spent with what is happening with the monetary side? Because at the moment it feels like over in the States the Fed is just kind of trying to hold back the fiscal, trying to just keep the economy on an even keel given the amount of fiscal spending that's happening. Europe's going to go through that maybe on a slightly sort of slower curve, but it is coming.
Yeah, I mean, I think there's different level to this question. I mean, if you look at the individual countries, particularly some, there's very little fiscal space there. We've seen significant fiscal slippage in France. Indeed, the S&P just revised down the ratings of France. So it's very difficult for France to spend more, similarly for Italy. But at least for some countries, there is still quite a lot of support coming through into the pipeline from Next Generation EU, of course, because so far they've only spent a very small proportion of that money. So that should provide a little bit of stimulus. And then coming to the most important part of your question, could they do a little bit more of joint spending? This is what everyone is thinking about, potentially even after the election, negotiation of the new 7-year EU budget. Could that unlock the potential for more joint spending on defence? So we think progress will be very gradual on that front. It's very difficult to justify more joint spending while you have only spent about a third of the previous Next Generation EU. So we think that will take some time, but it's probably coming. A possible election by Trump in the US could even be a bit of a trigger point for Europe to understand that they need to spend a little bit more. But the important thing when you think about defense spending is, does it actually favor Europe? Because, for instance, all the spending that has been done on Ukrainian defense so far, only actually 20% of that ended up benefiting Eurozone firms. 60% ended up benefiting US firms. So that's also something that EU has to work on, not just spending, but building the capacity to actually create more long-term growth.
Would you have to rewrite your forecasts on EU growth if there is a Trump presidency, given those threats of 10% tariffs?
Well, certainly the tariffs could be quite important. I mean, we always need to kind of see to what extent they will be applied, how they will apply. They will affect some sectors more than others, but it will probably affect some of the kind of the nascent trade recovery that we're seeing. You know, we know that the typical growth cycle in the Eurozone tend to be led by exports and then feeding into wages and investment. So certainly that could be a hiccup on that, as could be, for instance, a possible retaliation by China on some of the tariff that Europe has said yesterday that they would like to impose on EVs. So,
Fabio, I've got to leave it there. It's going to be an interesting day. I'm glad you're excited about it as well. I certainly am. We're watching the event a little bit later on in Frankfurt. Fabio Balboni, senior economist for the Eurozone at HSBC. A reminder, of course, there are multiple ways of getting Bloomberg coverage of this event. We will bring you the policy decision. That's coming at 1:15 UK time. We're also going to bring you President Lagarde's press conference. That's going to be half an hour later. There will be a T-Live, a top live blog that will be running throughout this entire event as well. So some great coverage, Tom, coming up right here on Bloomberg.
Yeah, and we were talking about the fiscal impulse, or maybe the challenge, or at least the constrained fiscal impulse coming through from the EU, even as it faces up to those challenges around defence, of course, and the green transition. Part of that will be part of the debate that filters through across the elections in the Eurozone, with the Netherlands the first country to kick off 4 days of voting in the European Parliament elections later today. More than 370 million people across 27 EU nations are eligible to vote. Let's bring in Bloomberg's Ollie Crook for the latest then. What is the timeline? Talk us about how this unfolds, Ollie.
Yeah, Tom, so the polls have been open for just about 2.5 hours in the Netherlands. So the first votes have already been cast in the EU election that will really set the course for the EU in the next 5 years. So the Netherlands will vote today. They will elect the 31 of their MEPs of the 720 in total. And then tomorrow we get Ireland, we get a couple on Saturday. But then really the main event is Sunday when you have France, Germany, Spain, and actually most of the EU voting for their delegates. Now, what do you get on Monday? You get an idea of the parties that have been elected to the parliament, the smaller parties. And then what happens from there is you need to figure out which of the sort of broader groups in the parliament these parties will actually go into, right? So some of these will not change, but there's some real question on the right. A, how well the far right is going to do, and B, where will these parties then sit into these individual groups, which then kicks the conversation to the EU leaders, and this is where you have the sort of cloak and dagger, backroom discussions of who they want to put forward to be the Commission president. The odds right now are probably Ursula von der Leyen. Then it goes back to the MEPs for their vote. They need to have a majority, and that is a secret ballot, guys, so anything could really go there. And Ursula von der Leyen only won by sort of 9 votes last time around. So things get kind of interesting there. But if everything goes smoothly, we should have the architecture of this new EU by sort of mid-July.
Ollie, as we watch events unfolding in Normandy, it is a reminder that Europe is facing a significant security threat coming from Russia. To what extent is that affecting what is happening with this voting? How big a factor could it be? We're obviously seeing a significant rise as well for right-wing parties. Again, how does that security narrative play into that?
Yeah, I mean, listen, this is a huge topic for the EU election, and obviously will vary from country to country. You go to the eastern flank, it's obviously the concern number one. I think that there is a real consciousness in Europe that the defense spending needs to get up there. The question is, how do you actually do that? Will there be joint debt? There's huge debate around that, obviously. But I think that also, Guy, when you think sort of more philosophically and you step back at what the EU is, I mean, it was really born by the end of this war. It was born out of that. The first EU election was in 1979, and it's all come to sort of prevent these kinds of wars. And when you think about the EU as a bloc and the challenges that it faces right now and the competition it faces from China and the United States, it really needs to decide how to undertake those challenges. And some of the policy solution from the likes of Macron and Scholz is a more unified Europe. Now, with this election, if you see sort of more Euroscepticism being sort of breathed into the European Parliament, could that slow it down? But it doesn't answer the fundamental question, how does Europe remain competitive?
Ollie Crook, thank you very much indeed. As you were discussing there with Guy, ripples of history as we look at live pictures of the 80th anniversary, of course, of those D-Day landings in Normandy. This is the American cemetery, I believe, in Normandy, of course, just beyond those beaches where 156,000 Allied servicemen landed 80 years ago today. We'll keep across this story for you and, of course, all the market implications of the ECB. Guy Johnson stays with us. Markets Today is wrapped up for today. The Pulse, though, with Guy Johnson is next. This is Bloomberg.